Using whole life insurance as a low-risk allocation to your portfolio is certainly not a new idea. It spans several decades. But there are some people in the opposition party who have claimed that the idea is bad, largely under the narrative that years ago there were a bunch of unscrupulous agents who hoodwinked people out of their hard-earned dollars by selling them overhyped policies that had no chance of ever meeting the expectations that were set for them. This happened, as the story goes, because interest rates were high at one time and they fell significantly over the course of the 90s and the 2000s and the 2010s. They like to reference the massively high interest rates that came about to combat inflation back in the late 70s, early 80s that led to much, much higher interest rates throughout the economy as a whole. We had things like double-digit mortgage rates. We had CDs that were paying in the teens when it came to annual percentage rates. And we had whole life insurance and universal life insurance policies that had lofty interest rate assumptions because of the bonds that life insurers were allowed to buy at the time. But as most of us know, the story took a turn. Interest rates did come back down, and as a result, a lot of those life insurance policies that were bought several decades ago never actually met the expectations in terms of the projections that were made with the cash values. And it's for this reason that we wag the finger of blame at several agents and insurance companies that were complacent in the practice of assuming these interest rates might persist forever. Today, I want to look at the data in terms of interest rates to try and find the point at which we would have been able to say, aha, we knew the writing was on the wall. These interest rates were not going to last. Because I think there's a number of things we can pull from doing this sort of analysis to question whether or not these people were really at fault when it came to the assumptions that they were making. And I think it also gives us some indication into what the near future will bring in terms of cash value building prospects when it comes to whole life and universal life insurance policies. I want to start this discussion focusing mostly on the 1990s. This was the decade that obviously preceded the moment of extraordinarily high interest rates that prevailed throughout some of the 1980s. We started the decade with the Fed funds rate at 8.23%, which was definitely lower than it sat for a long period of the decade preceding. And it didn't take all that long for the Fed funds rate to decline throughout this decade. By March of 1992, the rate had fallen below 4%. And in April of 1993, it hit a record below 3% rate, which was the first time the Fed funds rate had fallen to that level since 1963. But if we look at the actual chart, historically, of the Fed funds rate, it's somewhat difficult to pick out a point when we would have been able to say, here we go. This is the moment that we could pretty much tell everything was changing in the opposite direction of a high interest rate environment. So here we have the Fed funds rate from the early 1950s through current day, and we can look at 1990 starting right here and see that we have a 8 to 9% rate going on right here. In fact, as I mentioned earlier, it was 8.23% exactly at the start of the 1990s. And here's the point that rates fall down. And if we look at this, they have this period of much lower interest rate activity. But if we go back to the 1980s, we notice that there's a similar trend. It's not as low. If we go back to the 1970s, we also have a similar circumstance unfold. Again, not quite as low, but we see these periods where the interest rates drop and then they come back up, and they come back up considerably. This point here is sitting above 5% at the Fed funds rate. And by the time we get to the end of the decade, we're sitting above 6% for the Fed funds rate. Again, we have a recession. The rate goes down, and we have, again, this short period of time that rates sit at low levels. In fact, we hit new historical lows here, and we fell below 1% in the early 2000s following the dot-com bubble burst and 9/11. But true to the trend, we come back up, and we come back up to north of 5% in terms of the Fed funds rate. But then something really remarkable happens. We go through the most dramatic recession that the US economy has faced in a long, long time, and we see interest rates plummet to definite new records. In fact, if we look from October of 2008 to June of 2017, we have an unprecedented stretch where the Fed funds rate is below 1% for this entire time frame. That's a stretch of 9 years of interest rates, at least as expressed by the Fed funds rate, at incredibly unheard of lows. We don't have a time in history where the rate was that low for anywhere close to that long. And looking at that stretch right there, we may say, okay, this is the point when we should assume that interest rates payable on interest-sensitive sort of savings and or investments is simply going to be lower now. And by this time, I think that was kind of the prevailing sentiment. It'd be difficult to predict this moment if we go all the way back to, let's say, 1992, when we're buying a whole life policy under much different circumstances and much different assumptions. But sure, this period did arrive, and interest rates were, at least trending, in a direction that was substantially lower once we get to a sub 1% environment. But there's also something else that's unique about this time frame right here. So we have these really low interest rates. We have something else that happens though. One, we have an economy that booms. Stock market that looks incredible, but also we have extremely low inflation throughout this entire time frame. That's why interest rates stay so low. When it comes to interest rate policy, the Fed generally increases rates in order to combat the effects of inflation. So, as a way to cool down the economy and keep price levels more under control, there's an effort to slow down productivity, which is primarily done by increasing the cost of borrowing money because it slows down certain business investment activity. But if we don't have signs of heating up inflation, there's no motivation at the Federal Reserve's position to increase interest rates. So this 9 years long stretch of time where we have extraordinarily low Fed funds rate happens because the economy is advancing at a pretty good rate, but for whatever reason, we're not seeing much in the way of inflation. So without any massive motivation to raise rates, the Fed simply didn't do it. Now, there are various theories that are floated by other people about why this might have happened or what the Fed might have been intentionally or unintentionally interpreting to keep rates as low as they were. That's a discussion for other people to have. The fact of the matter is, typical metrics that look at inflation said we didn't have a problem. And if we're being very honest with ourselves, comparatively speaking, we really didn't have a problem. Because if we look at price levels from the 20-teens and compare them to what has unfolded post-COVID, we definitely see that the inflation that was insinuated during the 20-teens wasn't any kind of problem at all for most people. But the inflation that we have experienced post-COVID-19 pandemic shutdowns has absolutely been a problem for a lot of people that has been very far-reaching. And as such, we've seen a massive rise to the Fed funds rate, coming back over 5% at current time. But here's the bigger problem. Looking at this historical chart of the Fed funds rate since roughly the 90s, so this point onward, what point do you pick to say, okay, this is when we could say interest rates were absolutely going to go low and stay low for a longer period of time? Perhaps by here, we're at a point where it's been low for quite some time and we've got to start making some shifts to policy. But do you make that decision here? You would have been wrong. Do you make that decision here? You would have been wrong because they obviously came back up in these time frames. So that doesn't necessarily mean that we could automatically assume that this time frame right here was never ever going to happen again. In fact, there were a number of people during this time frame who expected scenarios much closer to this one to materialize because we were, as they put it, artificially holding interest rates low. However, there's another problem here. Looking at the Fed funds rate as a way to historically gauge what interest rate levels were is fine, but it's not the most practical way to look at this, at least in the eyes of what one would do with interest-sensitive savings or investments. Because if we're talking about life insurers, they buy bonds, and those bonds pay interest rates that are definitely different from the Fed funds rate. So to get a better sense of what interest rate realities life insurance companies were facing when it came to what they were going to pay for dividends or interest rates on their products, we have to look at corporate yields, and we can do that. This here in front of us is the Moody's index for AAA rated corporate bonds, which is a large percentage of what most insurers invest in, and we're looking at roughly the same time frame we were looking at for the Fed funds rate, going all the way back to the early 1950s. But again, our primary focus is probably 1980 and on. And what we see is a much more gradual change in interest rates than we noticed with the Fed funds rate. There's still definitely a peak in the early 1980s. The 1990s start out pretty high and do trend somewhat lower as we get into the next decade. And we also have periods of down and up interest rate activity, which we've kind of seen all along. But again, trying to figure out when that moment was that we were going to say, okay, those assumptions that we made that were based off interest rate activity, maybe from the 80s or even the early 90s, that's gone away. We need to change focus. I'm still having a hard time figuring that out. In fact, let's zoom in on something here. So this right here is the Moody's Corporate Index on AAA rated bonds from April of 1993 to July of 1995. This right here, April of 1993, remember, was the time point where we reached the lowest Fed funds rate since 1963. We can see that the corporate yields on AAA rated bonds, they follow a different trend because they absolutely were higher. They didn't bottom out in April of 1993. They sat at just under 7.5%. Now, they definitely go down, but then they rise back up quite considerably, and we end this time frame at basically where we started for the time frame. We're still at almost 7.5%. Now, I ask you, if you were going to, let's say, buy a policy sometime in the summer of 1995, and you were looking at this data here, and also knowing what happened in the early 90s, the late 80s, what would you predict would happen with interest rates moving forward, let's say the next 10 years? This right here is the graph that shows us what happened for the next 10 years. So we continued to edge up, actually going a little above 7.5%. We fell again, but we came back up again. And the trend is pretty flat if we average it out until we get to the end of the decade. We enter the new decade with a recession, and then we fall down, and we actually bottom out right at the end of this period, slightly below 5%. So in a 10-year time frame, corporate yields on AAA rated debt went from almost 7.5% down to just under 5%. I would find it difficult for somebody to predict that kind of movement in interest rate activity. Granted, it can be kind of volatile, but that's a pretty sharp decline. Now, there's something else, though, about all of this data that we should look at, especially when it comes to how life insurance interest rates or dividend rates play out, practically speaking, because it tells a story of the resiliency of yields or returns that are achievable on whole life policies in particular. We're now looking at a chart that shows a couple of different things, but the really important column is this dividend column. This is the historical dividend scale payable at Northwestern Mutual Life Insurance from 1992 to 2009. I'm using this one in particular because it was the easiest one to grab, but it's really representative of what most companies were dealing with when it came to whole life insurance dividends. They all kind of move in a similar fashion to one another. In fact, our data from a few years ago showed that Northwestern fell probably a little faster than some of the other insurers that are out there, but nonetheless, this one works just fine. So if we look at this data and we look specifically at the time frame we were just talking about, 1995 through 2005, what we see is we start at 8.5% being the dividend scale. And by the time we get to 2005, we're at 7.5% being the dividend scale. So the fall in terms of dividends payable to policyholders has not been nearly as significant as the fall that we have seen in yields payable on corporate bonds. Now, I've been in the life insurance business for quite some time, and I'm very, very intimately familiar with how whole life insurance policies work. And I do realize that dividend scales represented as interest rates are not the same as interest payable on an investment that you make. So I do understand that the dividend yield of a bond is different than the dividend scale of a whole life policy. But the point that I've always made over the years is that we can use this as a representative measurement of the movement in something over a time frame. In other words, a 7.5% interest rate at 8.1 versus a 5% interest rate at the end of the period is definitely different than an 8.5% interest rate at the beginning versus 7.5% at the end. No, they don't necessarily work off the same number, and we really can't reconcile them as pot of money times 8.5, pot of money times 7.5 versus pot of money versus 7.5 versus pot of money at 5%. But they do show us the relative magnitude of the movement, and we can definitely say that the change in dividends earned by policyholders at Northwestern Mutual did not fall as quickly as the yield one would achieve buying bonds in the corporate market rate for AAA rated bonds. Now, that statement all on its own may not seem all that remarkable. We would expect that life insurers should be able to invest at rates that aren't just what the general market bears out. Otherwise, why not just buy bonds? But there's a bigger point that I'm driving to that, to me, really explains why so many people owned whole life insurance policies or even universal life insurance policies, and after many decades of ownership, one day looked at their policy and said, well, that's different. The first point is this chart right here. This is October of 2008 to June of 2017 for AAA rated corporate debt. This is that same time frame that I mentioned earlier where the Fed funds rate sat at an unprecedented sub 1% interest rate for 9 years. And as you can see from this chart here, that same scenario did not play out for corporate yields. They started quite high and they kind of fluctuated, ending low, historically speaking, but we don't have a flat line that is constantly extraordinarily low like we saw for the Fed funds rate. In fact, I want to call your attention to this line right here, 4%. So this is, generally speaking, the guaranteed rate for whole life insurance contracts, or at least was until some changes that came about in the early 2020s. So as you can see, we have all of these periods here where debt purchased in the open market paid a higher yield than the guaranteed interest rate on a whole life policy. That represents a really good thing for life insurers. However, I should note that the closer we get to that 4% line, the less margin there is for life insurers, and so the greater stress that puts on their ability to continuously pay a dividend at whatever the current rate is. Ideally, they would like the spread between that 4% line and the yields they're buying bonds at to be substantially higher. But again, the point is the shift over time, if we look at the beginning point to the end point, it's not as dramatic as we saw with the Fed funds rate. Now, I want to return to this historical chart of corporate yields on AAA rated debt as recorded by Moody's that shows us this very long time frame. And yeah, we did have very high interest rates in the early 1980s. But if we look at this from the 1990s or the beginning of the 90s through current day, the trend here, as I mentioned earlier, it's much softer in terms of the reduction of interest rates than we see when we looked at the Fed funds rate. And I think really there's a big problem with respect to looking at this and trying to figure out when we would suggest that interest rate environment is turning around or turning in the opposite direction of what we had kind of expected. Yes, this time frame here left a pretty permanent mark on people's minds in terms of what interest rates might bear out. And when we fall but then come back up and fall and come back up, it's easy to see why people might not necessarily think we're headed into a period like this one right here. In other words, the movement in interest rates, or the gradual movement in interest rates, is kind of like weight gain for most adults. It's slow and insidious. If you were to gain 25 pounds in the course of a month, well, you'd probably notice, and a lot of other people would probably notice. But alternatively, if you gained 1 pound each month for the next 2 years, it probably wouldn't be something you took note of unless you were to see a photo of yourself from 2 years ago, at which point you'd say, well, dang, I think I've put on some weight. And I suspect the same scenario unfolded here. If you bought a policy in the early 1990s, it took some time for interest rates to fall to a point where they might have had a significant impact on your whole life policy. Keep in mind, if we go back to this historical dividend scenario from Northwestern, we see dividends not moving a huge amount over the entire decade. Yes, they end the 90s ultimately lower than they started the 90s, but that gradual reduction in dividend scale over the time frame results in a modest change in dividends paid, but not one that necessarily calls people's attention to a big shift. Now, we get all the way out here where it's suddenly remarkably lower than it was had we bought a policy back in 1992. We might start to notice that dividend payments are less and the cash value that we've accumulated is not exactly what we thought it was going to be. And it's not what we thought it was going to be as we project out past this number, out past this year here. But I also want to call your attention to something else. So obviously buying a policy sometime around here or even here results in dividend payments once you get out to here that are a good bit different. But what about the people who bought whole life or universal life policies here? Well, interest rates have gone down slightly, but now they're substantially higher than they were when you bought the policy. And they might stay substantially higher for some time. If you're following the financial news, you probably know that there's some back and forth with the Fed right now because they announced they were going to make rate cuts this year. They reiterated the fact that they intended to make 3 rate cuts not that long ago. But then they recently said, we'll see what happens. This is the case because, one, inflation is not dropping as quickly as the Fed maybe hoped. But in addition to that, the economy is not really struggling in this new higher interest rate environment. Sure, there are some industries that would prefer lower interest rates because they've grown accustomed to an environment over the course of the past 10 plus years where borrowing money cost virtually nothing. But just because those industries would prefer a scenario where interest rates are lower does not mean the Fed is going to grant their wish. In addition, inflation rates dropping are not all on their own an automatic scenario that results in reduction in interest rates at the Fed. The big motivator for reducing interest rates is slowing economic productivity. The Fed does not lower rates just because it feels like it, in the same sense that it isn't going to increase rates just because it feels like it, as we saw take place throughout the 2010s. So even if we get declining inflation data, we need slowing economic productivity in order to motivate massive decreases in interest rates at the Fed. So far, the economy has not shown trouble in the face of higher interest rates. And just because a lot of us got really comfortable with really cheap money over the course of the past decade plus time frame does not mean that we absolutely have to exist in an environment where that is the case. And now the growing consensus among banks and a lot of other finance people is the idea that we're going to see interest rates much higher over the course of the next 10 years than we saw over the last 10. That's not great news for people who like to borrow money, but it's great news for people who like to save, especially in low-risk asset classes. It also means something else. So life insurance policies, cash value life insurance policies, have a tendency to improve their efficiency over time. The implication here is, while you may own a policy today that was issued under higher interest rate assumptions 10, 15 plus years ago, that hasn't quite met the numbers that you thought were going to be the reality come today, you've already gotten past a lot of the expensive part of policy ownership. And if we see interest rates rising and staying higher over the course of the next 5 to 10 years, you have a more efficient policy by virtue of its age, taking advantage of higher interest rates that are prevailing under our current circumstances. And you're receiving those higher potential dividend and or interest payments at a time when your policy is just simply larger. So the impact in terms of net dollars paid to you is actually higher by virtue of having an older policy with more money on it than would have been the case if you received a higher dividend or higher interest payment on your policy maybe 1 or 2 years into it when you had very little money in the policy and far less efficiency of rate of return. So very simply put, there's a very good chance that a lot of people who have aged whole life and universal life insurance policies are going to start to see a growth in rate of return that is significantly better than what they've experienced for the past 5-ish years. The chances that these old policies were sold with overhyped, aggressive salespeople trying to convince people that something was going to happen that they themselves knew was never going to happen is highly unlikely. It's very hard to look at historical rates and not use the advantage of hindsight to say, well, we knew exactly when things were turning badly. It's difficult to project at any of those note points when exactly we would have been able to accurately predict the overall shift in interest rates, especially since the move down was quite gradual when you look at what insurers actually invest in, corporate debt. But the trend has turned around, and there's a good chance, given all of the data that we're looking at, that we're not going back to 1980s double-digit interest rates, but we probably are going to see interest rates higher than what we experienced for the past 10 to 15 years. And that will be a very positive upward momentum for life insurance policies. Thanks for hanging out with me today. We'll see you next time.